This is Taking Stock on Bloomberg. I'm Pimm Fox. U.S. mutual funds saw inflows. That's right, inflows of $660 million last week, ending 3 consecutive weeks of outflows. My next guest is focused on getting retail investors back into the game of investing. Joining us now for a CEO sit-down is Gregory Johnson. He's the president and chief executive of Franklin Resources. Great to have you with us. Thanks so much for coming in. So I mentioned $660 million going into mutual funds. You kind of scratch your head and say, gee, that's a big change, because money was leaving equity mutual funds and going into bond funds for such a long period of time.
Well, I think it has been frustrating for the industry, and despite a tremendous rebound in the markets, we haven't seen the retail investor coming back into equities. You know, I think the good news is most of them sat still during the market, and most have good exposure overall to domestic equities and global equities. But you really haven't seen a surge of new buyers coming in the marketplace.
All right, so without that surge of new buyers, what's a mutual fund company to do? How do you kind of generate the growth?
Well, there's lots of other areas. I mean, for example, for us, global bonds have been a tremendous new category where we've raised $150 billion in the last 4 years. Global equities have been very strong. Emerging markets bonds, alternatives, TIPS type funds have all been very strong and positive inflows. It's just been domestic equities that have had quite a bit of headwind.
All right, let's talk a little bit about equities outside the United States. Is it that people are getting the message that global growth, particularly in emerging markets, is the place to be, that that's where you're going to get that bang for your growth?
I think people are getting more comfortable with global equities, and it used to be an investor would nibble a little bit, 5% or so of their portfolio, and we've seen that number increase up to 20–25%, and it's a focus of our firm right now to make global equities the new core instead of domestic equities, and have exposure to the entire world versus being limited to just a smaller market.
All right, so those are equities outside the United States. You mentioned bond funds outside the U.S. Perhaps a little bit more exotic for some investors. Do they need to be trained that there's the currency risk as in those kinds of funds?
Well, I think for us, the area that's really exploded in growth in Europe and Asia and the U.S. has been global bonds and primarily sovereign debt. And I think a lot of that's just a lot of the developing markets are not comfortable with their own currencies. They want to protect their purchasing power, and it's a nice way to diversify a small segment of your assets to protect your purchasing power. So I think people are getting more sophisticated with currencies, and I also think, you know, the risk somewhat is now in the developing markets, not the emerging markets.
Well, you mentioned the risk in the developing markets. What's your take on what's going on in Europe right now? You think they're going to reach some kind of an agreement, or have you kind of been looking at the portfolios and seeing, is there anything in there that's in Greece?
Well, I leave that to the experts, and that's our portfolio people. I'd rather not speculate on. My beliefs aren't worth a whole lot on that area.
All right, so tell me about what you're doing to get people excited about investing in the United States, because you got so many international companies here that many investors say, well, why invest overseas when you can buy a U.S. company, U.S. listing requirements, U.S. accounting, and they do business overseas. Coca-Cola revenues over 80% outside the U.S.
No, I think that's right. I think we are really just trying to get people back into equities, whether it's domestic or global equities. And we did a campaign right at the bottom of the market called 2020 Vision, where we tried to get investors to focus on 10 years out, not looking at the next quarter or what's going to happen in the next headline. And I think that was very effective and well received by advisors for us.
How do you counter the worries of retail investors when they see the volatility, when they open the statements every quarter, and the performance is erratic at times because of, in fact, Bob Gelfand from MKBS was talking about this. You've got inflated asset prices in some cases because of central bank money printing. How do you kind of calm them down?
Well, I think, first of all, most investors are calm and have an advisor to help them. And there's a lot of activity at the surface. We look at net flows and we assume, well, the domestic guy's gone and equities are dead. But the reality is most people have stayed put and done very well through this cycle. So I think we want to educate new investors to get comfortable with equities. That's a big push. I think that's a big problem today, where younger investors are very risk averse to the marketplace, and I think that's problematic for the industry. But all in all, most investors stay put, stay the course, you know, and have done very well in the rebound.
All right, I want to thank you very much, Gregory Johnson. He's the chief executive of Franklin Resources, sharing your thoughts on the mutual fund industry. Thank you.
Thank you.